risk management, very broad topic, but essentially it's allocating a portion of your capital to opportunities that you see in the market. Now, if that opportunity doesn't work, obviously you need a trigger to get yourself out of that trade. So obviously that's a stop loss, but it's not just a stop loss which is randomly placed. You've got to use price action to place that stop loss. Now, a lot of traders, when they first start, they'll hit a stop loss and the price goes on to their desired target, and it just leaves a lot of frustration. Every trader's been through it. I'm sure a lot of you in here have been through periods where you've hit a stop loss and then it goes to where you thought it was going to go. Some say it's sod's law, but it's actually, in my opinion, the market knows where people are going to get active. The market knows where traders are going to interact with the market. Because don't forget, the market's been around for hundreds of years. So it's basically the emotions and thoughts of people. Price is the agreed emotions and thoughts of what people value that market at. And I can almost guarantee, if I share the screen, right, you can see my trading view screen. And if anybody trades US 500 as well, it was a nice move today. You can almost guarantee where people are going to put stop losses in the market. Here is a great place for a stop loss. So the market will probably go in there, because you've got this level retests. Got this level here. Where's the market going to go? Well, it's going to go through that, and then it's going to pull back. You see, again, just one or two examples. You can just go through all the charts and find areas where the market pushes through. Obviously some kind of flow scenario there, because if you get a strong candle on GN, you're usually going to see the same one on GA. Yep, just wanted to show that example. And what did GA do? Exactly the same thing. Popped through a level, pulled back. So I know diverging slightly here, but you can see where risk management can become a problem straight off the bat, because traders will use their technical analysis, which they've learned, place a stop loss outside of that technical analysis, which will get tagged all the time, and then the market moves to where you think it was going to go. Quick answer to that problem is suggestion is enter the market where you think you're wrong. So where you would the closest you can get to where you would consider yourself wrong. So essentially past the level. This is for new traders, by the way. If you've got a high success rate of your levels, like a lot of you have in the channel, you keep doing what you're doing. But if you keep getting stopped out, push your entry further back. So the market has developed over the years to basically trap unsuspecting market participants. Some people may say I'm just being like miserable again there, and just almost defeatist, but it's true. It's the evidence is there. I'm sure a lot of you've been through a similar thing where you're getting stopped out all the time, and then gives even more frustration because the market then goes where you want it to go. So obviously the initial part of risk management is restricting your losses, and that's where the stop loss obviously comes in. You've got to only allocate a portion of your capital to every opportunity that you see. Now, David said holding trades to the next level on the driver to see if there's a pullback. Now, entry is much more important than stop loss. Obviously, you have to have a stop loss on every trade that you take. But a lot of people spend so much time working on stop loss placement. And if you put the same energy into working on entry placement, you will have to worry less about the stop loss. That's part of the reason why I only trade sell action for a sell and buy action for a buy, rather than entering the market on this retest on pound New Zealand dollar. I want to see a sell level here, so I don't care how far up I need the market to go. So where did it go from today? There, let's go through the time frame, see if it went off any. And the issue with the trading this way is that sometimes you're going to miss, and it would have missed because my entry off that would have been there. So, but a good motto to have is you win some, you miss some is better than you win some, you lose some. So the refusing to take losses and waiting for the next setup is a massive problem for a lot of traders. There's a old saying, Sun Tzu, the Chinese warlord, I think he was Chinese, the battle is won before it's even fought. So obviously there's quite a lot of meaning in that, and basically says that if you're making plans if you're making plans on the fly as the market's moving, as the battle's going, you're not going to win. You've got to just trade your plan, because from what all your data, and there's a couple of people who I've spoken to this week who I don't know if Hatchie's on the call. He's saying that his technical analysis is spot on always, and he's doing the coaching. I've seen his technical analysis; it's spot on, but he isn't extracting the profits as much as he'd like, because he's not trading what he'd planned to do, because he is basically planning as he's fighting. And that's why I say to people, the trades that obviously it depends on your strategy. If you're a daily time frame, 4-hour time frame predominantly, the setups that are developed during the day are highly unlikely to be profitable for you. If you're a 15-minute trader, a couple of hours down the line, the market's moved on and you've got complete new analysis to look at. Now, obviously, with pound US dollar, there's an opportunity for me that could be developing now, but I've waited since 10 o'clock this morning for that potential setup. Now the analysis is in, If I get a retest of this 4-hour close, I might take the buy depending on the reasons for us getting there. That is a big issue as well for some traders. Failing to consider why the market is making moves, which is something we'll cover quickly shortly. But allocation of capital to opportunities in the market. You can't fight against moves. If you all of a sudden think, right, I don't want to take a loss here, I'm going to take another trade, I'm going to double up and try and get out. You hadn't planned to do that in the first place, and what happens is that the loss becomes so big that you think, I've not taken this loss, it's too much money for me to lose, and then the market just keeps going, and then you have to take a loss. If you can build into your strategy the ability to have flexibility and change your mind when the market is doing something different. But this comes with experience and knowing your own skills and you know what's going to work and what isn't going to work. Like the pound move this morning, 8 o'clock, market tanks, and then it gets a helping hand with stocks. So 8 o'clock, stocks tanks as well, but then later on, stocks pushes further a couple of times. So just taking trades on that currency pair from your tech isn't going to work. Now this is where the discretionary side of trading comes. If you've got a fairly high hit rate and you use like positive risk reward, you can ride through the losses. But what I see happening with a lot of traders is that the losses are just too much for them to take. They can't continue to trade and execute their plan in periods of drawdown. Periods of drawdown happens to everybody. Now, I need to stop sharing the screen and share it a different way so you can see this very basic chat GPT thing that I've put up. So FTMO account 100,000, risking 1% per trade. You're going to need 12 losers in a row, or 11, before you blow the account. That's a lot of losers in a row. And the chances of that, if you trade in your plan, are very small. There's a big chance that you'll get 2 or 3 losers in a row, even 4. It's at that point where traders start to, change their strategy, so that when the market does come conducive to taking trades using your strategy, when it comes good again, you've changed your strategy, so you have another period of losses. But what I will say is that people jump into funded account challenges far too soon. I've had people join the channel, people that I've met, out and about, and they join the channel and they come to me with their plan that they're going to watch the videos, they're going to do a couple of weeks on demo in the channel, and then they're going to do a challenge. And they literally think that they're going to pass the challenge, get funded, and then their life's going to change. And I just have to say, I have to be truthful with people and say, yeah, now the 2 weeks turn out to 2 years. And people think that I'm stupid or something. They think that, well, I'm going to be copying off what you're doing, so why can't I do it? I'm like, well, you don't understand. You've got to fuck around and find out. That people genuinely think that they can do a few weeks or a couple of months practicing and then get funded. It's not going to happen. Now, you see other communities. So traders, they drift from community to community because they'll see a lot of people sharing their results on social media. If it's something that you do, note down the names of these people, because they only stay around for a few weeks and then they disappear, and then somebody else appears to be smashing it, and then they disappear, and then somebody else. And this is how these social media traders work, because they just attract people in, because this trader at the time is genuinely doing well, but then when the market turns or they change their approach, or their psychology isn't up to it, it all falls on its ass. So, I've had so many traders in this channel that have done well for periods, and then they've gone off the boil, and then they've left and they've gone to another community, and I've seen them that they're doing all right for themselves, and then it's just the same pattern. It isn't the strategy, it isn't the community. It's down to you to have all these pillars in place all the time: the edge, the execution, the risk management, the psychology, and emotional control. You need to keep them together all the time while you're active in the market. It's hard. It is really hard to get to that level. Once you're there, and you know that being patient and sitting on your hands and doing nothing is the key, then that's where things start to improve. So that just want to cover as well a bit of risk management on funded account challenges, because people see it as, say for example, you've got $100,000 account, and you've got a maximum 5% drawdown on the day, 10% in total. People look at that as their pool to use, that pool of capital to use, that 100,000, like risk 1%, $1,000. If you lose your first trade, you've lost 10% of your working capital. In fact, if it's on the day, you've actually lost 20% of your working capital. Now, if you have another loss on the day and lose another percent, you've lost 40% of your allowance. So you've just blown 40% of your funded account. Now, people don't see it like that, but to be 40% down, because you've only got 10,000. Sorry, you've only got 5,000, and you've already blown over $2,000 of that. So you can see how it gets really close to the line, and can get there quickly as well when you have a market like today with strong moves. It's a ridiculous way of trading, and it's promoted by the prop firms. They promote taking 1% risk of every trade, 1 to 2% risk. I see some of them say that's fine if you're building up a bit of a buffer. So every time I do a funded account, I personally would just risk like $100 on the first trade, not $1,000, $100. See if I can get a decent 2-to-1, and then I'll risk that $200-300 on the next trade. See if I can get another 2-to-1, and then I might risk that $700 that I've got on the next trade. And if that works, I'm flying. I can start increasing it. These funded challenges are like games. They're not real trading. It's just you've got to get the challenge over the line. But people plow into them and literally messes with their mind, because they're fine. They're comfortable with a couple of losses. But once you start getting closer to that limit, logical thinking goes out the window generally. So I've seen on a review that I did today, the guy's levels are shit hot, but he can't sit on his hands whilst he's waiting for the market to get to his levels, to his areas of where he's going to interact. He'll trade gold in between waiting for his levels to hit, or he'll go down the time frames on currency pairs and look for other opportunities, because he thinks that action leads to profitability. So he thinks that the more work he does, the more money he's going to make. But it really is the activity that kills traders. Inactivity is key. You've got to just be good at doing nothing. Look at your data. Again, the battle's won before it's fought. If almost every trader that does the coaching, and I'm only mentioning the coaching because that's the only time I get to see traders' data and statistics. When they start, 90% of traders don't need any help from me. And it's because they're being accountable, and they only want to take the trades from what they've identified at the start of the day when they've done their daily data sheet. If you start taking trades that are not on that sheet and you start incurring losses, then you've got to, answer to me, like, why? Give you reasoning, and some people feel fucking stupid. Like, there's, you're not upsetting me. You're basically just pushing back that goal every time you jump into a trade that you haven't planned to take. You're pushing back the end goal further and further every time. And even when the trades that you plan to take work, it's probably the worst thing that can happen, because that is basically telling the brain that you can do these random actions and be rewarded from it. It's how they train dogs, isn't it? It's in that trading in the zone. Like, you give it a random reward and it keeps on doing it just in case it gets the reward. It's exactly the same. And part of me, I know that a lot of these traders who share their results on social media every time they get a fucking winning trade, like a fucking happy dog that's been given a treat, they never show the times that they've done the trick and not got a fucking treat from it. They've just got a punch in the face from the market. So stay in your lane. Like, don't be drawn in by what else goes on around there. And this will be covered a lot in the psychology and emotional control one. There's a lot that I'm going to go through in that one. That will definitely be an hour's rant. So if you want to laugh, that'll be a good one, probably Thursday. We'll so stay in your own lane, do your plan, allocate your risk to a trade, a setup. If you don't want to be a discretionary trader, if you don't want to have to decide whether a trade's good to take or not, you don't have to. You've just got to understand that you need a high hit rate. And if you haven't got a high hit rate, the only thing that's the problem is that you're taking shit trades. Like, this is what a lot of people won't admit to themselves. Like, they're looking for a reason in why, they're not making the progress, and it's generally because they're just taking shit trades. Like, technical analysis isn't good enough. And everything you ever need to know about technical analysis is in front of you on TradingView. Years and years, decades of price action. Just go back a few years on market replay. Play the market. Do the analysis as the market's moving along. And it'll build confidence. And there's enough opportunities in the market for you not to have to sit on the screen all day hunting for them. Like going through the daily chart earlier on, there's a few just daily levels that have done massive moves in the past few weeks. Euro USD, there, yesterday's level played out. I know it obviously got a helping hand today, but Aussie US dollar. Dollar CAD level played out there. So there's plenty of opportunities, and people could make a lot more profit and have better trading results by just setting some orders in the morning if your technical analysis is good enough, placing your stop loss in the right area and your target, and then just letting it play out and not have any stress. Obviously you need to be careful, because part of risk management as well, capital allocation, is if you've got a couple of trades running or you've got several orders, and you don't want to be picking up more risk on the same move. So if you've got pound New Zealand dollar buy and a pound Aussie buy, and they're both coming down to the area where you're going to interact with the market, you're instantly doubling your risk there. So you don't really want to be doing that. It's important that you track the the amount of exposure that you've got in the market at any one given time, because if you've got history of like fighting against moves and trying to average out by adding positions, if you double the risk already to start with, and then you're taking one position on top of that, you see how things are going to get out of hand really quickly. It's all about capital preservation. If you're at the start of your journey, you're not as you're likely to be a break-even trader. Don't think about the rewards. Think about the process. The rewards will come. They're part of the process. Failure cannot live. It cannot exist with persistence. Because the more you're doing it and the more you're learning, and I don't mean be persistent by persistently being a prick, and persistently breaking your rules, and persistently being a fucking knobhead, excuse the language. Like, you're never going to get anywhere there. The key is to be persistent in your learning and your data collection and your journaling. Journaling is boring. It's the shittest part, and I see some people come and do the coaching, and I know that they can't be arsed with it. And I'm like, well, you're fucking paying for this. I'm not your dad. I'm not going to be holding your hand to do the data. You've got to do it, because the boring and shit is the only way to make money long term, to find the consistency. And you get to a point where you're doing really well, and you can back off from the journaling a little bit. But then as soon as things start going wrong, you have to get back in the journal and discover why. It's the best tool you'll ever have when you're learning to trade, is journaling your data. Because even if you don't know what you're doing at the time, or you don't know what to do with the data, there'll be a time down the line where you will know what to do with it. So you'll thank yourself massively for actually doing the work, because in the future that work will change your life potentially. Even if you just use Edgewonk to do it rather than manually editing. Edgewonk is fantastic. it'll tell you where your shortcomings are. So the risk reward, the risk management part of funded accounts is a big thing for me. Is that, so you've got 5% max drawdown for the day. That's their rule. It doesn't have to be yours, and it should not be yours. It can't be your rule. Obviously, because if you get near the 5%, you breach it, but it doesn't mean that your max drawdown for the day is 4.9%, which is what I genuinely see a lot of. And do you know when it happens the most is when traders. So what have you got to get? You've got to get 10,000 past the challenge. They've got $8,000 profit. A trade's going against them, and they think, "Oh, I'm not going to take this loss. I'm going to hold it and see what happens." And they'll keep fucking seeing what happens until it gets to 4.9% drawdown, which is fucking ridiculous. That's trading your P&L, that is, to an extreme way. But that extreme way is encouraged by the rules set out by the prop firm. I've seen it so many times that traders are in decent profit and they don't want to take a loss because they've got so much of this wiggle room, and they genuinely think the market's going to come back. The market can do anything it wants. The market can stay unreasonable for longer than you can stay liquid. And we have these moves now and again, and I call them the market taking its taxes. It's testing everybody. Testing who's got the right risk management skills, who's got the right ability to stay out of a move until flows come to an end. It tests everybody. It takes taxes. You know, in a way that could have been the move this morning. That's probably taken a lot of names and kicked a lot of asses. And genuinely, though, isn't even that big of a move. There's been bigger moves on Euro USD. I know pound is the one that at the brunt of the move, but it's not even that big of a move. There's loads of candles which are similar. It's nothing out of the ordinary. If we got down to here, that would have been fantastic today. Would have smashed a lot of people, but that would have been the easiest trade that you'll take all year. So don't accept these rules from the prop firms. And again, if you've got your own capital, don't have similar rules to prop firms. You need to have a figure, a drawdown figure on the day that if you lose X amount, you pull the plug and walk away. Because you need to be in the right mental state, and you don't really know if you're going to be in the right mental state if you're a new trader. And if you keep hitting this max drawdown every day and you think, fucking, I'm doing this every day, you're not ready to be trading. You need to understand what problems you have and why do you have the problems. So your results from your trading tell you exactly what you need to do. So your actions that you're taking, if you've journaled them, you need to find out why you're making these mistakes, and then put together a plan to stop you from making those mistakes. You know, and every Friday I say to people, how did you get on this week? And then it's like half-assed answers. I want people to give me loads of work to do on a Friday. Open forum. How did you get on this week? Tell me what mistake you've made. Even if it's a small mistake. Because notice the pattern. You might make that small mistake all the time. And if I can't help you, somebody else in the channel might be able to help you. And if it's a really interesting problem, I'll go out and find an answer for you if I don't know it. Like, I want this community to be full of serious traders, not fucking Instagram show-offs who make, who get a little bit of a payout now and again, and then think that they've made it in life. I've coached people who've made it in life fucking 30 times. They've made it in life in their mind because I've had traders who've had a good week and they think, oh, I've turned the table now. This is it now. This is fucking bollocks. That's what that is. Everything's got to be on point all the time. Just because somebody's had a good week or even a month, you might find that the market has just been going one way and they've been trading in that favourable direction. And then as soon as the market starts going sideways or changes trend, then they're back to getting pummeled again. So set your rules. I don't want to give you a figure to implement as your max daily loss. But, take a look at your trading history. What do you consider to be a bad day? What do you think, if you lost that amount, you'd be pissed off? Well, don't go to that amount to piss you off. But then stepping away from the market when you hit that amount, again, is another skill. Because if you're not pissed off, you're likely to want to dip back into the market, especially if an opportunity presents itself. But you've got to be rigid. And on the opposite side of that, what I see a lot of traders talking about as well in the past is a bullshit profit target for the day. Now, if you have had a really good start of the day and you're 1% up, 2%, don't think, right, I've done now for the day. If the market is conducive to your trading style at that time, is favourable towards your edge, ram it home. Keep trading until the market isn't conducive on the day. Don't limit your upside. So what I see a lot of traders doing is limiting their upside, but their downside is unlimited. Because they don't want to take a loss, but they want to snatch at the profit. You need to flip that the other way around. Limit your loss. Don't limit your upside. And there's numerous ways of not limiting your upside, and that's leaving a bit of a position on when it hits your target. If you're finding that you're getting a lot of good trades, but you're leaving a lot on the table, start looking into it. That's your problem. You're not taking enough from your trades. Why are you having that problem? Because when you see in profit, you got to bank it. It's a psychological thing. You're trading your profit and loss. You're trading your P&L. You've got to trade the market. You've got to trade the moves. If your data is clearly telling you that you can hold your trades longer, hold your trades longer. But you have to also understand that sometimes the market is going to get to where you would have closed it in the past, and then it's going to turn on you. It's part of the game. It's a cost of playing the game of trading. Because over time, the extended targets are going to, those losses are going to pale in insignificance. So don't limit your upside. Sorry, I've missed a couple of questions there. Wellesley had yourself risky situations, quite stupid. I think that's purely having the discipline to stick with what I know. Yeah, absolutely. You know what works. You know what your edge is. Like, a thing that pisses me off about these SMC, ICT, whatever it's called, traders, they're championing the strategy. And they've got these fancy charts on social media with all these abbreviations and nice technical analysis to draw traders in, to new traders in, to make them think it's really good. It's not the technical analysis that makes the money for people. It's you. You are the edge. All the pillars, again, strategy, execution, risk management, psychology. It's all, you are the edge, not the strategy. You might find that one single bit of that strategy works for you really well all the time. Just trade that. Like the 4 hour close retest for me has been playing a blinder recently. I highly doubt that cable's going to get down there. Needed another 25 pips. Still interested in it, but just to the size of that candle, it didn't think that I didn't think that the market could get back down there. Hasn't yet, but that if I just traded that one strategy, yeah, I probably wouldn't get that many trades, but I know my hit rate would be really good. So somebody in their personal review today, it was their last week, and they've come to the realization this week that the strategy that we trade, the level strategy, isn't just one blanket strategy. The market moves in different ways all the time, and the different types of technical analysis, so intradays, different types of levels, different types of moves, like risk-driven moves, currency-driven moves. You need a different approach for each of those. So you can actually break down the strategy into individual smaller strategies, and you, for your journaling and your risk management, you can allocate your risk accordingly to the type of move. So if I'm going to buy a level on pound US dollar today, here, if I'm going to buy that, now we'll go down the time frame. Now at this time, when the market came down here, if I had an order here, I need to understand why the market's getting there. So this is for my risk allocation. Do I just want to cover that level? It's a really, really tight zone of 3 pips. So do I want to take that level with a 4 pips, 5 pip stop loss? If it's a pound only move, yeah, I'd take it with a 5 pip stop loss, no problem. So my risk reward there with a 5 pip stop loss to my target, which is 23, let's say 20 pips. So I've got a 4-to-1 risk reward there, so would have been a nice opportunity. So what I see a lot of traders doing is they'll just still take that setup with the same risk, the same stop loss, and then when the market does actually do the move, because it did the move straight away, it just did a little bit more drawdown. See, did the move straight away, and then even came back to the same area of potential struggle later on after a further drawdown, which was an aggressive entry for me, using the same 4-hour strategy but on the 15-minute. The reason you have to change your risk management on this trade is because at that time Euro USD was driving the market. It was dollar strength that was driving the market. Stocks had already stopped at a level. 15-minute. I've updated my analysis. Sorry, just so that 4-hour level there, get rid of that so it's the only one on the chart. Go down to the 15-minute. So my zone on Euro USD was 10 pips. So I can have like a 12 pip stop loss on that. I need the equivalent on cable, because I'm not going to enter cable until Euro USD hits that level. So I could this my entry, I'm going to get a better entry than the tech off here because I'm not trading a pound US dollar move. I'm trading a market move at a US dollar move. So for me to just take that with a stop loss covering the zone is nonsense. It's you're going to take a lot of losses if you're doing that. So this is why understanding why the market is moving and having a risk management style for each type of move. So my risk management style, and not forgetting the execution, because the execution is the most important part of this trade, is I would generally take pound US dollar. When euro US dollar hits that level, I will buy cable without a stop loss. Not to say that I'm taking this, free range without a stop loss and just allowing the market to go against me, because I'm not going to do that. If euro USD breaches this level, I will bin my pound US dollar. I'll literally just hit close straight away. But that means that my entry was a decent entry. That means that I could be sort of 8 or 9 pips in drawdown and then dump it. But what a lot of traders will be doing is having a 20-30 pip stop loss on that. Far too much exposure than you actually need. So you can earn the right to have better risk reward by being patient and waiting for whatever's driving the market to hit the level first, and then you can take the trade on your. So you're still trading this level on cable, but your execution of the level is according to the market. Now, if this does sound a little bit complicated, just let me know, because there's videos in the members area, and if it's still complicated, let me know, and we'll just do a whole lesson on entry and flows. We've had loads of them, but I'm always happy to go over the same things again, because the more questions people ask, the more different ways I may explain something, and then it'll start clicking with more people. So I know everybody learns differently, and there's not one. I know how important it is for people to have things tailored towards them. So this is why if I do every topic to death, it's going to help a lot more people. Wellesley, would you say building a personal account rather than working off them was the best way to go while in the learning phase? Personal experience, you definitely care a lot more about taking it. Yeah, of course. I see lots of people who do really well on demo because they don't care. But they generally do really well on demo because they'll allow bigger drawdowns, because there's nothing stopping them from losing fake money. So they'll allow those drawdowns, and then I would say, have something in, skin in the game. Have an account with some money in, because it's just, you've committed to it then. But again, before these prop firms would become prevalent, most of the market, most of social media, most of people I knew from trading communities were boom bust traders. So these traders, you've probably seen them, they would be experts in flipping, apparent experts in flipping accounts from like £500, £1,000 up to £10,000, £20,000. But then they disappear, and then they'll come back and do it again because they haven't got any consistency. They just go on a good run, flip that account. And this is what I see with funded accounts as well, because people go on a good run, they get an account, they blow it. They go on a good run, they pass a challenge, pass a verification, go on a good run, get some payouts, blow it. These are exactly the same traders. The trader hasn't changed it's the platform and the accounts that have changed. So these traders, they'll show off their funded account payouts are literally the same traders who just are boom and bust. They'll show off when they've flipped an account, but then disappear for a while. It's just all about consistency. Slow gains, again, failure can't compete with persistence. You just got to keep trading, keep journaling, keep sticking to your plan. Now, to blow a funded account, obviously, if you're risking 1%, if you're risking 0.5% per trade, it's like 24 trades in a row to breach the account. It should be impossible if you're well risk managed and trading a plan and have some knowledge of trading, some skills. Because again, just to go back to that point where traders are taking these challenges too soon, don't learn and don't think that you're going to get better whilst trading a funded account challenge, because it's the worst environment possible to learn if you have got a lot of weaknesses that need developing. And I just want to go on to self-sabotage as well, because that, for me, essentially is part of the problem with these trading these accounts. You've got to, if you get stopped out by a spread, that's self-sabotage. If you get stopped out because you didn't know what time the market closed and you got caught out, and when the market opened it was a gap and it caused you losses, self-sabotage. If these are things that you should know, things like what if you ride close to the maximum loss on an account, know what time that it resets, because I've seen somebody it blew a challenge because he thought that after 10 o'clock when after market close, he thought that his daily drawdown allowance reset, so he took another trade between like 10 and midnight and took another loss, and it took him over. And again, that's self-sabotage, because you've gone against, these are problems which are going to cause us pain, which we shouldn't have to have. It's just about knowing the boundaries and the limitations of your trading software, of the broker. This is why the learning curve for trading is so big, because people are just keen to trade without actually considering everything else. It's shit learning to trade. It can be shit, but it's only shit if you don't follow a process and a plan. If you've got a feedback loop of making a plan, journaling, finding out why you've got the problems, putting things in place to stop these problems, it's actually very, very rewarding. But you've just got to stick to that plan. Your risk management's got to be the thing that keeps you in the game long enough to learn. I don't think there's anything else really, because it's not like a specific, this is your risk management, this is what you need to do to improve as a trader. I just wanted a generalization of, risk management and what, the things that you need to do to conserve capital, because capital preservation is literally number one rule. Like, so another example of something I saw from reviews this week is a trader didn't take an opportunity which they had in their... They'd already noted it down, and they didn't take it because they thought that flows were in play, and they were afraid, basically. Just a little bit of fear crept in. But then later on, whilst they were driving, they've looked at their phone and saw Euro USD at a level and not bothered to do any checks and just took the trade. Now, trading it's so easy to allocate capital, to put your capital at risk. Like, the trade that he didn't take had pound US dollar at a level, Euro USD. Sorry, it was a pound yen trade, but pound US dollar was at a level, Nikkei was at a level, the whole market was at a level, and he didn't take the trade, but then flippantly opened his phone and took a trade on Euro USD. Can you see the nonchalance of that? Like, I used to do it a little bit as well. I myself, like, you'd have a bit of frustration throughout the day and you think, oh, that looks right, fuck it, I'll just take it. When to have three markets at a level, like two major Nikkei, a cable, and pound yen sitting at a level, for you to not take that trade, even if you took that and it's a loss, if I'm reading that in your journal, I'm saying you have to take that. Similar to dollar yen this morning. Before the move happened, dollar yen was literally... The only reason to not take that trade is because the market missed and then moved sideways. But if you haven't been watching the market and you had an order set on dollar yen, if flows start when the market is almost bang on the level that you're entering at, it's part of the game, unfortunately. There's nothing you can do about that. I'm not going to go through somebody's journal and say you shouldn't have stuck pound yen. Flows were happening. Literally, you were in the market as flows happened. Both things happened at the same time. It's tough shit. But, you know, losses happen. I don't trade dollar yen because it's fucking shit. Well, it's not. It gives opportunities, but I was just lucky that I trade pound yen, and that wasn't at a level at the time, and then it pushed to a level, and then it played out perfectly. So just by the choice of pair that you trade, it could have caused you to have a loss today. It's just the way it is sometimes. But as long as you're allocating the correct amount of capital and you've only lost a controlled amount, then you're free to look for the next opportunity. And then if you take another one and it loses again, you might have to just think, fucking hell, it might not be my day today. I'll just go off screen until things settle down. We're not in the game of it's not a computer game where we fight against the moves. And again, remember, when the market stops, when strong moves stop, we almost always move into a period of consolidations, which is, again, a completely different way of trading, different risk management, but some of the easiest trades you'll ever have. What generally happens is traders will fight against a strong move. They'll open their phone when they're driving and think, oh, fuck it, I'll try that, fuck it. Take all these nonchalant trades which are not thought out. And then after they've been smashed, the next day they then think, oh, I'm only going to take the trades from the strongest levels now. So they miss out on all the fucking easy trades which you could nonchalantly take on your phone at the right time. So you can see how psychology is an important part, because you're actions the day before have now caused you to miss out on profit the next day. So you've had losses and missed profit. So you can see how, as traders, we're just in like a shit position unless you've got patience and an edge that works in the market and risk management to keep us in the game. Create your rules. I don't want to say to you that if you lose this amount, stop trading for the day. Pick a number. Journal. See how that number works. I would say if you are going to stop trading after 2% loss on a funded account on the day, it's too much. Because in 2 days, if you have 2 bad days, that account could be seriously at risk. So for a funded account, I would, as I explained how I approach it at the start, with the small risk to start with, get a bit of a pool. Remember, your pool is $5,000, not $100,000. $5,000. If your problem is hitting the max drawdown and you never get anywhere near the daily drawdown, then your pool is $10,000, of course. So some rules for one person with a funded account might not work for others. This is why data collection and actually paying attention to what your results are and the reasons behind your actions. If anybody's got any questions, just fire them in now, or if you're watching on YouTube, just drop a comment and I'll get back to you. I think, yeah, I'll go back. Minimize risk exposure 0.3%. More than that position makes me feel uncomfortable. Checking trade yeah, exactly that. You'll find that balance psychologically. Again, something we'll cover in the psychology video webinar. You'll find the sweet spot for you. I generally go with what sort of profit have I been making. If I was to take a loss of X amount, how many days would that take me to recover? So if I look at it and think, right, I've made 4% in the past month, I don't want to be ruining my month's work, do I? So, but if you've not got any profit to go on, then your problem isn't your risk management, is it? Your problem is stop taking shit trades. So this is why I mean you need this feedback loop. What is your problem and why are you having that problem? What can you do to improve that? Because traders all go down the same path. They start trading, get a load of stop losses, try to work out how to not get that stop loss hit, when you really need to work out where to get into the market so your stop loss doesn't become an issue. And it's not magic. Like I said, there's decades worth of charts in front of you. Every question you ever have about trading can be answered in the chart, but it's understanding how to extract that information which is the key, which we'll do a little bit on that next week probably in the channel. Anybody got any questions? Has it been helpful at all, or have I not covered what you wanted to cover? Because I've still got a few minutes. If anybody's got anything they want me to discuss about risk management, let me know now, or forever hold your peace. Moved away from demo purely because bigger stop loss is different, but yeah, it is a different ball game. Nice one. cheers, guys. Psychology and emotional control we'll have a look at probably Thursday now.